The last piece of trade management here is really also a type of scaling out, except for it's not scaling out for your profits. It is scaling out to manage your drawdown. Now, let's say, for an example, to paint you a picture of how this works, you cruise out to Home Depot or some other hardware store to get an item to make a home repair. And you see that that item has a price listed on the shelf of $10. And you feel that the value of that item is absolutely worth $10. You agree to pay the $10. And so then you head to the register. When you get to the checkout, though, the item scans in at $8. Well, you saved $2. So you actually spent less. You agreed to pay $10, but it actually only cost you $8. So in essence, you made money by spending less. Now, the same concept plays out in trading as well. We make money by protecting our capital. And one way we can do that that's really cool is by managing our drawdown or having our trades cost us less. Look at this example here. Here we are on the dollar-yen pair, and we're on the 1 hour chart, okay? We are in a very strong uptrend, and to the left, we see that it's been in an uptrend for a long time, and so we see there's a lot of momentum here. Now, we have that, and we have just had a retracement where price came back down and retraced here, and we are seeing that we just had this another really strong close here on this hourly candle. And in this example, there is great volume in the market, and we are looking for momentum to carry us to the next structure level, which is 80 pips away. We're imagining it's up here. And so here is our exit. This is where we're looking for, price and momentum, and our setup and our trade experience to take us is to this 80 pip level. Now, at the time that we enter here at our entry level, our stop loss here is 40 pips. And so this is a 40 pip from our entry to our stop loss. And where we're looking for our trade is 80 pips from our entry to our take profit to, or our exit point in our trade. Now, this blue arrow right here is a halfway point between our entry and our 40 pip stop loss. So it's a 20 pip half stop loss mark, okay? And I have this marked here. Soon as I enter the trade, before I ever enter the trade, I already in my mind know where the 50% mark of my stop loss is at. In this example, we're now dropping down to the 30-minute chart, where before we were on the hourly chart. So now we're looking to manage our trade and our entry on this lower time frame. Okay, and so what we see is that price absolutely, we've entered here for a buy, and we see that price goes in our direction, moves up about 22 pips. It wicks out here before then price drops down to right past this 50% of our stop loss position. This half stop loss line, remember that we had drawn over here, it was 20 pips. Our total stop loss is 40 pips, and price has already dropped down to this half stop loss point. In managing your drawdown, you may at this point close 50% or some portion of your trade. Because listen, if the trade continues going against you, you will not lose the entire $10 for the entire 40 pip stop loss that you had, because you took 50% off the table. You'll only lose about $7.50 or $8, just depending on exactly the point where you exit your trade. And here also in this third graphic, we are still on the 30-minute chart on the dollar yen. And what we find out is what we didn't know here. We closed 50% of our position as that price did not end up coming up 22 pips, hitting about the half of our stop loss, and then moving up in our direction. That is not what price just did. What we found out is that yes, from our entry level here. Price went in our direction about 22 pips, wicked out with a rejection, and then price continued to fall before it hit our stop loss. And so we were stopped out. But because we managed our drawdown, the fact that we closed 50% of our trade early cost us less than the original $10 that we placed on this trade. Now, even though we closed 50% at the 50% loss mark, it isn't exactly a 50% discount because you have spreads as well as other factors, affecting your exact exit point. You can figure that instead of losing exactly $7.50, it'd probably be closer to $8. But the point is that you went in going, hey, I absolutely feel really good about this trade. I'm willing to risk $10 here to make $20 here. I feel really, really good about this. And so because you closed 50% of your position here at the half point of your stop loss, when you started to see price going against you, even though price could have then reversed and hit your absolute very, very cool 80 pip, take profit and closed your trade, but price didn't do that. And so what you did was you managed your drawdown. And when price hit this 50%, you closed 50% of your position, and then finally price went all the way and your trade was closed out. Now, very, very few traders consistently do this. And I'm not saying that you have to 100% have it as part of your trade, as part of your strategy. And you may for sure have a personality that, if the trade ended, just like I said, and ended up bouncing back and going totally in your favor, that you could not emotionally handle the fact that you closed 50% of the trade and now you didn't win, the entire $20 that you placed on the trade, that now you would win less than that because you did close 50% when price hit this before it finally, went to hit your, exit signal or your take profit. But I will say this, and that is why I include this in this and I teach it to everybody, is that when my husband and I both instituted this practice into our trading plan, both of our results changed drastically. I doubt I will ever go back to a strategy where I do just straight stop loss and no drawdown management. And I doubt John will either, because we saw such a difference in our statistics and in the numbers and what money stayed in our pocket. It just made that much of a difference for both of us. And I guarantee that if you test in this and institute this practice in your trading, it will protect your capital and put you way ahead of other new traders. Now, how much you pull off the table and at what level, that you decide to pull money off the table is totally up to you. In this example, I pulled 50% off at the 50%, or half stop loss mark. But I can tell you that is really close to what John and I both do in our live trades every day. Occasionally I might be closer to like the 70 to 75%, mark of my stop loss, maybe closer to this before I close. But I mean, always somewhere in between this range, I am taking a portion off the table because I like to save money. I like to protect my capital and I like to spend less. But my advice is look at instituting this and put this as part of the trade management that you work into your winning strategy.